Hi there, welcome to NEP Invest. Time to have another look at a financial year 22 results from a company on the ASX. And in today's video, I'm going to be looking at Lindsay Australia. I haven't had a close look at this company in the past, but based off their financial year 22 results with some pretty good growth in profits and revenue from the previous year, I thought I'd just take a little bit of a closer look to this company. And the market has taken notice to this company as well. We'll have a look at the chart, the weekly chart and the daily chart. And this company share price is moving in a well-defined uptrend. So the market is loving Lindsay Australia. So let's get stuck into it. But before we have a look at their financial year 22 results, what does this company do? In fact, you may have seen some Lindsay Australia trucks transporting stuff around because this company is integrated transport, logistics, and rural supply company. They do have three divisions. Lindsay Rural, which supplies more than 1,500 farmers with an extensive range of agricultural products, including packaging, fertilizers, chemicals, and integration or irrigation equipment. Lindsay Transport, they deliver more than 1.6 million tons of freight to over 5,000 customers along Australia's east coast each year. So those are probably the trucks you might have seen. They also have rail as well. And Lindsay Fresh Logistics, a transport and logistics provider located in the Brisbane markets, providing unloading, cross-deck docking, storage, ripening, fumigation, and import-export services. Before we have a closer look at Lindsay Australia, these are some of the companies, 5 companies I'll be focusing on their financial year 22 results in a video during the next few weeks. Xtech, Energy One, CSL Data 3, and Car Sales. If you have a suggestion, a company you would like me to focus on in a video, particularly focusing on their financial year 22 results, just leave that company in the comment section of this video, and perhaps I'll have a look and do a video on that company. The first step in my research process when a company releases their financial results is determining the quality of a company. Is it a high quality company or is it a low quality company? Because I treat high quality companies a little bit different than low quality companies. And I did a video on this, so look out for that video. In fact, I might leave a card or something above here. So click on that if you want to know how I treat high quality companies different than low quality companies. Now, in regards to Lindsay Australia, I'm indifferent, unsure about the quality of this company. If I had to pick, I'd say it's more towards a high quality spectrum than the low quality spectrum. And one of the reasons behind that is because of the consistent growth in revenue over the past 10 years. We'll have a look at the growth in revenue later in the video. And also, the share price has grown, has increased over the past 10 years. Not a consistent rate like revenue. There's been periods of time when the share price has done nothing. In fact, share price has fallen over a long period of time. So that could be one negative thing, that you might see the share price of this company just go sideways or down for a long period of time. But if I had to have a pick, if there was a gun to my head, I'd probably say Lindsay Australia is more of a high quality company than a low quality company, which means value is more important to me in regards to this company right now than the share price trend and the sentiment of the company. Sometimes you could determine the quality of the company just by looking at a long-term chart. Is a share price in an uptrend, a long-term uptrend? So this is the weekly chart for Lindsay Australia going back to 2012, and the share price has increased from 2012 to 2022. But there was a long period of time between 2015 and 2021. The share price of this company went sideways. In fact, there was a period of time when the share price was in a sort of a very slow meandering downtrend between about 2017 and 2020. And then the share price started to turn up. So even though we did have a long period of time when the share price does or did absolutely nothing, doesn't mean this company is low quality. In fact, Microsoft, and I'll talk about Microsoft when I look at CSL. Microsoft between 2000 and 2013, their share price went sideways. A 13-year period where Microsoft's share price went sideways, even though the company grew their revenue, grew their earnings per share over that period of time. And the reason why the share price of Microsoft went sideways over a 13-year period was because of the valuation back in 2000. Now on to financial year 22 results for Lindsay Australia. So before we have a look at the results, share price of this company is around about 60 cents. So have a look at the share price. The markets right now are quite volatile, but the good thing is Lindsay Australia's share price is going up when the overall market is going down. So this is one of those companies that is bucking the trend. There is positive sentiment in this company right now because of their financial year 22 results. So let's have a look at their results. But before I have a look at the results, the market cap of the company, if I forgot to mention it, is $183 million. So not that high when you look at the revenue of the company, 557 million in financial year 22, profit 19.2 million, which was significantly higher than financial year 21. Operating cash flow, now the reported operating cash flow of the company was a little bit different than the way I calculate operating cash flow. And I'll talk about that when we look at the cash flow statement. But I calculated the operating cash flow as 2.8 million and the earnings per share is 6.4 cents. So the reason why my calculated operating cash flow is quite a bit lower than Lindsay Australia's sort of operating cash flow that they did report is because I take away leases, and this company spent leases on rentals and also property. So rentals of property, renting the offices, that sort of thing. And I believe, in my opinion, those sort of leases are operating leases and should be taken away from the operating cash flow because they're not one-offs. This company every single year will spend money to rent out the offices, that sort of thing. So I do believe that you should take that into account when you're looking at the financial statements of a company. Now on to one of the reasons why I think this might be a high quality company. Probably not the highest quality company on the ASX and probably far from it, but a wide broad group of companies that belong in the high quality spectrum. But one of the reasons why I think Lindsay Australia might fit into that group is because revenue has been growing consistently over the past 10 years. This is exactly what I want to see for a high quality company. Revenue has grown from 260 million to 556 million. And when you look at the revenue per share increase, and that's very important for all companies because a company could be increasing the revenue over a 10-year period, but the shares on issue could be increasing at a greater rate, which means the revenue per share is actually falling. But when you look at Lindsay Australia's revenue per share growth over the past 10 years, 3% per year, over the past 5 years, 8.7%, and over the past 3 years, 12.1%. And the 3-year growth has been helped because of the growth in revenue from financial year 21 to financial year 22, increasing from $439 million to $556 million. So the first thing I want to do as I further my research in this company is why was there a significant increase in revenue from last year to this year? Now onto the cash flow statement for the company. And there's a few things I want to look out for here. The first thing is receipts. So receipts have grown from 480 million to 581 million. The second thing is operating cash flow. Now, interestingly enough, operating cash flow actually fell from last year to this year. So even though profit grew significantly from about 1.8 million or something to 19 million, operating cash flow fell from 51.7 million to 39.6 million. So I want to understand why that is true. Not only that, the company did spend $13.7 million on capital expenditure. That's payments for property, plant, and equipment. They spent $28.2 million on property lease liabilities, $8.1 million on other lease liabilities, and $488,000 on equipment lease liabilities. And that's not including dividends paid. So because this company was actually free cash flow negative, if you take into account that the capital expenditure and the lease liabilities, this company actually increased their borrowings this year. So proceeds from borrowings, $20 million, repayments of borrowings, $5.5 million. So they increased their loans by $15 million. Now, that might not be negative, so we have to dive a little bit deeper to why the operating cash flow actually fell from last year to this year. So we have to go to note 26 to get an explanation behind that. And when you go to note 26, we can understand why this is not a concern, that operating cash flow fell from last year to this year. Now let's have a look at note 26, which is the reconciliation of profit to the operating cash flow. And this is really important because this is how we see how a company gets from their profit to the operating cash flow. And we can understand why the operating cash flow fell from last year, 51.7 million to 39.6 million. The first thing we need to look at is depreciation and amortization, and there's no big changes there. And this is actually one of the reasons why there's a significant difference between profit for this company and operating cash flow, because and depreciation was $38.6 million this year. But the main thing I want to focus on here in this note 26 is changes in working capital. This is the reason why there was a decrease in operating cash flow from last year to this year, particularly a significant increase in trade receivables. That increase in trade receivables last year was 5.9 million, and this year was 33.5 million. So that means there's a lot of cash going to be coming in the future, maybe the next few months, into Lindsay Australia's kitty, because these are debtors. This is money owed to Lindsay Australia. The other thing we want to focus on is any changes in inventories, and there was an increase in inventories by 4.1 million, and any changes in trade payables. In fact, there was an increase in trade payables by 12.9 million, which was actually lower than the increase in trade payables than last year. So the main reason why the operating cash flow was lower this year was because of that significant increase in trade receivables. And for instance, if that trade receivables was only $13 million increase, that means the operating cash flow for this year would have been $8 million higher than last year. So you can just see how you have to take a little bit of a closer look to the information in the cash flow statement to get an understanding of how a company is performing. If you just looked at the cash flow statement, you might think, just based off the operating cash flow decrease, that this company was performing worse than last year. But that's not true if you take a look at note 26. And in fact, the company explained this in their presentation. So possibly you didn't have to go through all this work. So this is the operating cash flow slide, and they actually mentioned in the commentary, operating cash flow decreased by 23.4% to 39.6 million, primarily as a result of rising debtor balances. So that's that change, that increase in trade receivables. Debtor balances increased with revenue growth. Also, an inventory stock build undertaking due to global supply chain. So there was an increase in inventories as well. And they go further. They say operating cash flow is expected to normalize in financial year 23 and return to historical cash conversions levels as working capital pressures and global supply chain disruptions ease. So I would expect that the operating cash flow actually increased from financial year 22 to financial year 23 by a pretty good clip if the company keeps on performing in their day-to-day business. Now onto some valuation metrics, looking at PE ratio, price to sales ratio, price to operating cash flow. We've also done a reverse DCF just to see how this company has to grow in regards to the earnings per share to justify the current valuation, and it's not that high. Current PE ratio, 9.4. So that's actually pretty good value in this company if they can maintain the momentum this company is experiencing right now. You might question that, whether this company with their transport division might continue to grow over the next few years, simply because of a pretty big bump in revenue from last year to this year. Price to sales ratio is 0.32. Now, the price to operating cash flow based off the operating cash flow I calculated, when you take into account leases, is 64.2. But if you use the operating cash flow this company reported, you get a price to operating cash flow of 4.5, which is really, really low, which also might suggest this company is pretty good value right now. And again, that reverse DCF, how much would this company have to increase their earnings per share to justify the current valuation? It's not too high. It's only 1.17% per year over the next 10 years. Now onto the daily chart, and the market has taken notice to Lindsay Australia. The market has really liked what this company has provided to the market in relation to their financial year 22 results. The share price of this company was in a nice, slowly moving uptrend from, now this goes back to March 2021, all the way through to just before the company released their financial results, and the share price has really zoomed higher over the past month or 2 months. In fact, the share price has increased from about 45 cents to about 64 cents. But based off the valuation, there's more to run for this company over the next year, particularly if the company can continue to grow at the rate it has been growing over the past 5 years. So there might be still good value for this company moving forward. That's all I have for this video, looking at Lindsay Australia and their financial year 22 results. There might be some good value for this company. So even though the share price has gone on the run, I'm keeping a close eye on this company. And if I do see a significant pullback in the share price because the overall markets are in a hissy fit, I might take a position in this company, probably a small position at first, and then I might build my position over time if the company continues the momentum this company has seen over the past few years. If you have any thoughts, any comments, any questions, leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.